Wow, 2025. It feels like just yesterday we were all talking about the metaverse, and now it's all about the institutional adoption of crypto regulation and AI.
Crazy, right?
Yeah, it's definitely moving fast. And it's more important than ever to really understand what's going on. Volatility, rapid changes, and information asymmetry make it so tough to trade crypto, and
Yeah.
you really need solid, well-grounded strategies.
Absolutely. And that's exactly why we're doing this deep dive today. We're going to break down 8 contemporary crypto trading strategies for 2025. We pulled these from an in-depth study that we've been working on, all designed to maximize profits and, super importantly, minimize risk in these crazy volatile
And
markets.
we got to emphasize that these strategies aren't just guesses. They're built on really strong technical and financial foundations. Our goal is to provide a practical guide to help you navigate this complexity. Right on. So for all of you out there who are tackling crypto trading, we hope this analysis serves as a clear roadmap. It's a tough landscape out there, and we get that you need the right tools to deal with all the volatility and, often, the lack of readily available information.
Let's kick things off with the first strategy, advanced technical analysis powered by AI. What implications does this combination hold?
Okay, let's unpack this. This strategy brings together those classic, reliable technical indicators like RSI, MACD, moving averages, Bollinger Bands, the usual suspects, and combines them with the predictive power of machine learning algorithms.
The cool thing here is how AI enhances traditional analysis. Instead of just relying on humans to interpret chart patterns, algorithms can process huge amounts of data, right? And this optimizes identifying those key signals and helps reduce the chance of getting false signals. Some deep learning algorithms, like recurrent neural networks, those RNNs, they've actually shown a really impressive ability to pick up those complex time-based dependencies and price series, which those classic indicators might miss on their own.
Exactly. So the main benefit is, of course, automating this whole analysis. Saves time and effort. And it gives you much better accuracy when pinpointing the best times to open or close a position.
If we relate this back to the listener's experience, integrating AI into technical analysis becomes a powerful tool for discerning more reliable trading signals. Ultimately, this leads to fewer operational errors and, hopefully, more informed decision-making. Just imagine an AI system alerting you about a bullish divergence in RSI that's also backed by let's say, an unusual surge in trading volume. That's a combo that manual analysis might just miss altogether.
Let's move on to the second strategy. Swing trading based on medium-term trends. What makes this approach stand out?
So this one focuses on capturing profits within directional movements that unfold over several days or even weeks. It's different from day trading, which chases quick profits in the short term. Swing trading takes a longer-term perspective, trying to ride those market waves in a more relaxed way.
And the key here seems to be combining different types of analysis, right?
Exactly. Effective swing trading isn't just about charts and technical indicators. It includes actively tracking fundamental events that can affect asset value. Things like, announcements of new disruptive tech, game-changing updates to blockchain protocols, big moves by institutional investors. The correlation between these events and the observed technical patterns can really strengthen your conviction in a particular trend.
So the advantage for the trader lies in.
Less vulnerability to that daily market noise, those erratic fluctuations that lead to confusion and impulsive decisions. By focusing on broader trends supported by those fundamental catalysts, your decisions tend to be more rational and less influenced by that crazy intraday volatility. For the listener aiming for returns without the intensity and constant dedication of day trading, this can be a great alternative. It allows for a less hectic analysis and, let's be honest, more flexible time management.
Our third strategy brings us to the realm of automation. Algorithmic trading bots. How do they actually work?
Trading bots are computer programs designed to execute buy and sell orders for digital assets automatically. They follow a set of rules and parameters that you define. These criteria might include things like those key price levels, support and resistance, significant trading volume thresholds, or even a combo of multiple technical signals pointing to a potential opportunity.
And some of these programs are even more advanced, aren't they?
Oh, for sure. There are bots out there with adaptive logic and even machine learning capabilities. This lets them continuously analyze market conditions and adjust their trading strategies in real time. They're always trying to optimize performance and adapt to those evolving market dynamics. A bot with machine learning, for example, might realize that a historically profitable technical pattern is not working so well anymore, so it'll modify its operating parameters accordingly.
So what's the biggest perk of this automation for the trader?
Uninterrupted operation. It's a big one. Bots can run 24/7, capitalizing on those opportunities that a human trader might just miss because of, time constraints or honestly just getting tired and losing focus. And on top of that, automation pretty much eliminates emotional bias in decision-making, which is often a big factor undermining trader performance. For the listener, this means the ability to trade efficiently and consistently without needing constant monitoring and all that psychological pressure that comes with making decisions in real time.
The fourth strategy addresses short selling, but with an important caveat: hedging strategies. Why are they so crucial in this context?
Shorting, or going short, means you're speculating on an asset's value going down. While it can be a way to make money in bearish markets, it also carries inherent risk, especially in that unstable crypto environment where price swings can be so sudden and huge. Hedging strategies are critical for mitigating that risk and protecting your capital.
Could you give us some examples of these hedges?
Sure, hedges can involve using stable coins to preserve your capital's value when the underlying asset depreciates, or employing derivatives, like futures or put options, to limit potential losses if the price goes against you. For example, a trader could put options on Bitcoin to protect against a significant price drop.
So the benefit of shorting with hedging is
The opportunity to profit even when the overall market's going down, but importantly, with controlled and defined risk exposure. However, and this is crucial, shorting requires a deep understanding of how the market works and how to use those hedging tools properly. Lack of caution or misunderstanding these instruments can lead to significant losses.
Our fifth strategy focuses on diversification, but not just any kind, strategic diversification within the crypto ecosystem itself. What does this entail exactly?
Strategic diversification in the crypto world goes beyond just holding a bunch of different digital currencies. It means distributing your investment capital across different asset classes that make up the crypto ecosystem. You need to consider their unique functionalities, risks, and growth potential.
Can you mention some of these asset categories?
Definitely. We're talking about investments in blockchain infrastructure projects that support the network's operation. Stablecoins that offer parity with fiat currencies and less volatility, tokens from projects focused on, say, AI with huge disruptive potential, decentralized finance platforms, DeFi, offering alternative financial services, among others. The goal is to choose assets with different risk profiles and low correlation between their price movements.
So what's the main advantage of this smart diversification?
Minimizing systemic risk, the risk associated with the entire crypto market as a whole. By not putting all your eggs in one basket, so to speak, you reduce the portfolio's vulnerability to negative events that might impact a specific sector of the market. This contributes to greater stability in the overall portfolio return and strengthens its financial resilience in the face of those market fluctuations. For the listener, the key takeaway is to avoid excessive concentration in a single type of crypto asset. Distribute capital wisely.
The sixth strategy explores the psychological dimension of the market: sentiment analysis-based trading. How do you assess and utilize this collective sentiment?
Sentiment analysis seeks to understand the prevailing opinion or attitude of market participants towards a particular asset or the market as a whole. Different methodologies are used to interpret this collective behavior and anticipate potential price movements based on crowd psychology.
What kind of tools are used for this purpose?
We've got things like fear and greed indexes, which try to quantify the overall level of optimism or pessimism among investors. You can also do linguistic analysis of conversations on social media platforms to identify trends in the tone and frequency of mentions about certain assets. And then there's social volume metrics, tracking the activity, discussions surrounding specific cryptocurrencies on various online platforms.
How does this information translate into a trading tactic?
It's all about anticipating herd behavior. For example, a sudden surge in greed might suggest a possible price bubble or an overbought situation, while widespread fear could indicate a buying opportunity at an oversold point. The advantage here is identifying potential turning points in market trends early on, based not just on technical data, but also on the collective psychology of investors. For the listener, understanding how emotions can influence those digital asset prices can be a valuable tool for making more informed and less impulsive investment decisions.
The seventh strategy presents a more gradual and methodical approach: dollar cost averaging, or DCA, investing. What exactly does this technique involve?
Dollar cost averaging is an investment strategy that involves making regular purchases of a fixed amount of an asset at predetermined intervals, regardless of the asset's price at that specific moment. For example, investing 100 euros in Ethereum every 2 weeks.
Why is it especially beneficial for assets like Bitcoin or Ethereum?
Because they're assets with strong long-term fundamentals and significant growth potential, but they also experience considerable volatility in the short to medium term. By investing a fixed amount of money regularly, the investor ends up acquiring more units of the asset when the price is low and fewer units when the price is high. This process helps to smooth out the average purchase price over time.
And what's the main benefit for the investor who applies this strategy?
It lessens the impact of volatility on the average acquisition price of the asset. By avoiding the need to try and predict market lows, DCA reduces the risk of making a large purchase of an asset right before a major price correction. For the listener, this is a way to invest gradually and mitigate the risk associated with trying to time the market. It's particularly suitable for investors with a long-term investment horizon and a lower tolerance for short-term volatility.
Finally, we arrive at our 8th strategy, which focuses on risk management, taking profits and limiting losses through tiered levels. How is this put into practice?
This strategy involves presetting specific price levels at which you'll partially liquidate positions with a profit, take profit, and levels at which you'll close a position to limit potential losses, stop loss. These levels should be based on technical analysis, such as relevant resistance or support levels, or the investor's individual risk tolerance. The key is to define multiple levels instead of just one.
Why is it advantageous to set tiered levels for taking profits and controlling losses?
It allows you to secure some of the profits you've made as the price moves favorably, instead of risking losing them if the price pulls back before reaching a single profit target. Similarly, having multiple stop-loss levels can help manage risk more gradually and adapt to different scenarios of adverse market movements. Automating the execution of these orders is crucial to ensure compliance without the influence of emotions or hesitation at those critical moments.
What's the primary advantage of this strategy for the trader?
It enables objective and disciplined risk management, significantly reducing the influence of emotions in trading decisions. By predefining exit points, you protect your invested capital and strengthen operational discipline, essential elements for sustainable profitability in cryptocurrency trading. For the listener, this is a practical tool for setting clear boundaries and safeguarding investments against sudden, unexpected market moves. To wrap things up, it's clear that cryptocurrency trading in 2025 requires an approach that combines analytical rigor with prudent, well-defined risk management.
Absolutely. The 8 strategies we've explored today provide a robust and diverse framework, integrating both traditional analysis techniques and those innovative possibilities offered by these new emerging technologies.
And it's crucial to remember that sustained profitability doesn't come from the isolated application of a single strategy. It comes from the intelligent and coherent combination of complementary approaches, always under the watchful eye of meticulous risk management tailored to the investor's individual profile.
Plus, incorporating those automated tools and AI definitely gives you a significant competitive edge in today's digital asset trading landscape.
For those who want to implement these strategies effectively, we've put together some essential practical recommendations.
Starting with a crucial self-assessment. Diagnose your own risk profile, whether it's conservative, moderate, or aggressive, and set those clear, realistic financial goals with a defined time horizon.
Then choose at least 2 strategies that complement each other, considering both your level of prior trading experience and the amount of time and resources you can dedicate to this activity.
Designing a comprehensive, well-structured trading plan is a must. This plan should detail the specific criteria for entering and exiting trades, the precise rules for managing your invested capital, and those defined procedures for objectively evaluating performance.
Keeping a detailed record of all your trades, a trading journal, is an essential practice for analyzing performance, identifying recurring patterns, recognizing mistakes, and feeding back into that continuous improvement process of your strategy.
Implementing automation tools like configurable trading bots, customized technical alerts, or those advanced algorithmic trading platforms can really streamline the efficient execution of those strategies.
Ongoing education and staying updated are fundamental pillars. Keeping up to date on technical and fundamental analysis, trading psychology, and the application of artificial intelligence in financial markets is essential for adapting to that ever-changing environment.
Regularly evaluating those results using relevant quantitative metrics, such as the net profitability generated, the percentage of successful trades completed, and the maximum capital drawdown experienced, provides an objective view of the actual performance of the implemented strategies.
Finally, staying informed about regulatory changes in the cryptocurrency space, significant macroeconomic events, and disruptive technological advancements that could impact the market is an ongoing but necessary task to navigate this space in an informed sound and strategic manner.
Ultimately, venturing into the complex world of crypto trading in 2025 demands much more than intuition or luck. It requires a deep understanding of those available strategies and, above all, a disciplined, well-founded application tailored to the market's dynamic conditions.
We encourage you to carefully consider how these 8 strategies could effectively integrate into your own investment or trading approach. Personalization and continuous adaptation to those market conditions are key elements for achieving long-term success in this fascinating and challenging field.
With that in mind, we leave you with a question for future reflection. How is the increasing sophistication of trading tools, powered by AI and machine learning, transforming the role of the individual investor in the cryptocurrency markets? And what are the long-term implications of this technological revolution on participation and democratizing access to financial markets?